Hey, fellow investors, have you ever wondered how to create a steady stream of income while growing your wealth? Well, today, we're diving into the essential steps to build a high-yield dividend portfolio. This strategy is perfect for those who want to enjoy consistent returns and long-term growth. First, let's talk about the foundation of any great dividend portfolio. Companies with a history of consistent dividend payments. These are the reliable players in the market, often referred to as dividend aristocrats. They have a proven track record of rewarding their shareholders year after year. Think of them as the dependable friends who always show up when you need them. But here's the catch. Not all high-yield stocks are created equal. Some can be traps, offering high returns initially, but failing to sustain them. That's why prioritizing dividend growth stocks over high-yield traps is crucial. These stocks might not offer the highest yield up front, but their potential for growth makes them a smarter choice in the long run. Diversification is another key player in this game. By spreading your investments across various industries, you reduce the risk of being overly dependent on a single sector. It's like not putting all your eggs in one basket. For instance, you could invest in technology, healthcare, utilities, and consumer goods to create a balanced portfolio. Now let's get a bit technical. The dividend payout ratio is a metric you should always check. It tells you how much of a company's earnings are being paid out as dividends. A ratio that's too high might indicate that the company is overextending itself, which could lead to unsustainable dividends. Aim for companies with a healthy payout ratio, typically below 60%. Strong cash flow and low debt are also non-negotiables. Companies with robust cash flow are better equipped to maintain and grow their dividends. Low debt levels further ensure that the company isn't overburdened, making it a safer bet for your portfolio. One of the smartest moves you can make is reinvesting your dividends. This strategy, known as dividend reinvestment, allows you to buy more shares with your earnings, leading to compounding returns over time. It's like planting a tree and watching it grow bigger and stronger every year. For those who prefer a hands-off approach, ETFs can be a great way to gain exposure to multiple dividend stocks. They offer diversification and are managed by professionals, making them a convenient option for beginners and seasoned investors alike. Inflation is another factor to consider. Always monitor inflation-adjusted yields to ensure that your investments are keeping up with the rising cost of living. This step is crucial for preserving the purchasing power of your returns. Lastly, remember that building a high-yield dividend portfolio isn't a one-time task. Regularly review and rebalance your portfolio to adapt to market changes and ensure it aligns with your financial goals. So there you have it, folks. By focusing on consistent dividend payers, avoiding high-yield traps, diversifying, and keeping an eye on key metrics, you can create a portfolio that not only provides steady income, but also grows over time. If you found this video helpful, don't forget to like, share, and comment below. And hit that notification bell so you never miss an update. Let's grow our wealth together.